Today's number is 7 because what we're witnessing is history in the making. One of the largest dark pool transactions from Wall Street has just come through on one of the most important sectors in the market, semiconductors. With that in mind, and of course earnings season in front of us, what exactly is going on? We know this is the most volatile month of the year in October, and we also know that we've got some euphoric runs. But could this be just the tip of an iceberg and big problems are on the horizon? Well, in today's video, we'll break down stocks, commodities, and cryptos to understand what you need to be looking at and, of course, where the big problems may lie. Guys, this is going to be a good one. We'll see you in a moment. Well, welcome back, guys, to The Daily Show. My name's Thomas Atkinson, and in today's video, we'll be taking a look at the latest macro, the dark pool liquidity from Wall Street, and of course, our favorite, margin debt statistics. Yes, guys, they're at it again, and it looks like retail is piling in at levels faster than before. And you know what we say on this channel, each bubble must be bigger than the next one, and markets can stay irrational longer than you can remain solvent. The latest data coming in here for September has us at an absolutely astronomical number. And of course, it means that more and more people are getting euphoria, getting FOMO, and driving these markets up, driven by debt. We've already seen the big banks start to give their earnings. And of course, as we suspected, they're all pretty much coming in very hot, with regional banks starting to come in a little bit questionable when the market's taking a look at the quality of their debts. But just like the 2000s, 2007, 2018, and even, of course, that post-COVID run into crash of 22, each one must be higher. So let's take a look at what this could mean in terms of the short term in the markets and, of course, the longer term scenarios that we're seeing right now. And on the short term, some dark pool liquidity, some large Wall Street trades have started to come through, particularly focused on two main things. One of them is, of course, UVIX, which is long VIX futures on leverage, which just saw two pretty large transactions come through. And of course, no spike yet, but the possibility now that maybe volatility is just around the corner with some big tech earnings, especially next week. And then we saw dark pool liquidity start to rise back up on semiconductors. And this has a lot of people starting to go, well, wait a second, are we seeing a topping style pattern? Well, we'll talk about whether it's probably a top or just a temporary kind of sneeze in markets. Because while this is a very big one, the 7th largest transaction ever, coupled with the 10th only a little while ago, it's not quite what we saw back in that August period of 2024, where semiconductors actually underperformed the market for months and months and months before resurfacing after Liberation Day this year. Take a look at this, where the chart actually has seen the large transaction. We've got a recovery from those tweets, and then of course we've got this massive dark pool that's come through. Now, you could argue this possibly is a buy, but most likely when you're starting to see it around the level of the 10th largest trade, you're starting to say, well, is this a little bit of take profiting? But just remember, what happens here on the charts is not so much about the read itself, it's the reaction to that read. Are we going to see a market that continues up higher, breaks a new close high, and therefore probably more on the squeeze side? Or are we going to see a sell that takes out this stop loss level here and this support, and then, of course, activates further shorting? Well, it could be that this is one of the most important charts on your charting list right now, which is semiconductors. And as we've long argued, if semiconductors are going up, do not fight the market. If semiconductors are going down, it's going to be very difficult for the major indices to actually go anywhere. What is it, like 45% of the market is now tech? So, of course, what the big tech does, everything else tends to follow. So let's take a look at why there is a possibility that this is a trap. First up, weekly net buying in single stocks, according to Bank of America's latest data, shows that we are now on the 5th largest buy the dip inflow since 2008. Now, notoriously, these have been pretty decent buys still when you're looking at the longer term. Of course, dollar cost averaging and buying the dip is a pretty decent strategy, especially when you've got the government and you've got the Federal Reserve kind of acting as stopgaps for every drop. Hey guys, we've got some liquidity. Hey guys, we've got interest rate cuts, etc., etc., etc. The list goes on. We know that story. But what maybe is more important this year is this one. I saw this one from the opening bell here, Phil Rosen over on X. And he's actually tracked every one of the major tweets here from Trump. And what you'll actually notice is that it's been pretty accurate in actually changing trends. So, of course, we have here that recently the China tariff threat, the market's dumped off, and then we get the post, don't worry about China, it will all be fine. And all of a sudden, the market has rallied up. Now, this means that it's going to be important, as we've already argued this week, to be tracking this type of stuff along with price action and recognizing the break levels and what they're coming with. Is the story, based on, let's say a truth or a tweet or whatever it is now that we call it, or is it also based on great technicals? Because remember, you might think, well, wait a second, do we just follow this account and then we just check that out? Or do we actually use the overall key break zones? And I would argue that key break zones are very important because, of course, we know the options market moves a lot of this, and we do have, of course, updated options levels that we need to be talking about. Let's now have a look at average performance after a crash like we saw last Friday. Obviously, the week after the crash, according to Gunjan here, is generally positive. And you can see most of the stats show that there's a positive return. Now, the week after that, which is next week, can sometimes bring in a little bit more negativity. So it's important to note that that is there. But some of the good signs for now anyway are, as you can see here from Blue Kurtic, that we haven't actually seen some of the major crosses that bring kind of the more perilous markets, something similar to what we saw in February of this year or something similar to a 2021 crash. To me, at the moment, the market looks more like these types of conditions, and that is that we're getting a dip followed by the potential of even a possibility of mean reversion, and then maybe we're going to get a rip. Because do remember the November stats that we've shown so far have really been quite positive in similar scenarios. And you'll notice here that if we look at some of the best bull market analogs, so these are, of course, the overlaid most unique structures to what we're currently seeing, a lot of them actually do trundle higher and have more of a problem kind of in that area that would be more towards next year, maybe even in January and February, where we often do see that secondary pullback. And then markets actually may have done a lot of their gains. So what that means is that we might actually go into a higher level of volatility. Now, if you are in Australia and you're around Canada, around the Gold Coast or Brisbane, I didn't know Canada was in Australia, guys, then definitely think about coming to our free seminar event, because I'll actually be talking about our 2026 thoughts and processes, and that's going to be unique for that particular event. So definitely check it out. If you can get to it and you're in Australia, definitely check it out. Links in the description down below and pin comment. But just as a side note, it's very important whenever you're looking at these markets to look at the structure. And that's something that, of course, we're doing here on the channel at FX Evolution, because we know that when the Fed cuts, the structure is going to be really key. So looking at those analogs and looking at which market segments are doing best over the next couple of months is going to tell us a lot about the next 12 months. So don't worry, guys. We'll also be discussing some of it here on the channel. So let's have a look here at consensus reports, because, of course, we're seeing some signs of maybe a little bit more worry. There's definitely more signs than we've had for a long time in this market that things are getting a little bit sneaky. But the consensus is that they expect a 7% net income growth in the third quarter. The question is, has the market already built in all of those profits? Is it a, buy the rumor, sell the fact style market? Or is it a kind of, wait, we haven't expected such good earnings and we need to go up because the earnings were even better than we expect? So far, what we've seen is pretty much everything's hitting or beating, but the market is not really reacting that positively to it. So it's kind of looks like it's very priced in, because remember, we are priced to what we call perfection. It's kind of the Goldilocks style scenario here in the markets. Another issue is that Harvard Business School just put out this one here, which shows that since the major tariff announcements, actually imported and domestic costs have gone up. Now, you might say, well, wait a second, why are we not necessarily witnessing this? Well, I'm sure a lot of you guys that come from the US are possibly witnessing this on the ground level. But because of the nature of how they work out inflation, plus the data, plus everything else, you might not be seeing it in some of the data statistics just yet. A lot of it also hasn't been passed on to the end consumer yet, because as we saw in a recent Goldman Sachs study, what's happening is most of the businesses are holding between 60 and 70% of the rises themselves for now. What if that gets passed on to the American consumer, though? Will there be a problem? That's another question that, of course, we've got to ask, along with, will inflation return? And it's long lasting on our channel that we've talked about certain asset classes that benefit from this type of environment. Not only an AI boom, but at the same time an infrastructure boom, at the same time as a defense boom, at the same time as a geopolitical kind of situation, plus possibly the debasement of several fiat currencies. And what has been our favorite investment? Well, it's been gold and silver. And you guys would know this. We also quite like Bitcoin as well when you're taking a look at it in that context. Now, why is this so important? Well, recently here, Mark Ungewitter over on X posted this, and we've been kind of talking about the same story for probably about $150 to $200 an ounce, which is that gold is still up, but it has hit our now big target, which is 4,200. And we do expect that volatility will be just around the corner. Temporary tops, not necessarily tops, but temporary tops often are caused when you get this high. And actually, there are some all-time points here that we're seeing now with gold and many others. Gold has created history once again, with the RSI now being above 65 for 33 days straight. And this is pretty wild when you have a look at it. Is it bad for the long term? No. It actually shows strength, begets strength. There's more strength usually around on the horizon. But what is it problematic for? It's problematic for the short term. So you can see here the stats are not so clear when you're looking at 1 month, 2 months, 3 months. And what I'm noticing at the moment, I'm sure you guys are, is supposedly here in Australia, if you go and buy a gold bar, they're charging 15% above spot. Oh, that's a ripoff, guys. Don't be doing that. That is so stupid. 15% above spot. But they're also just saying, don't come. We don't want you at this store. We don't have any. We just have none. There's none left. So you might think, well, that's going to create epic squeezes. But I think that's actually been the storyline for a while. In fact, I think Costco's been sold out of both silver and gold every single time it's hit the shelf for 6 months, pretty much straight. So what other things are we seeing? We can see here Subu Trade has the value of gold call volume to put volume as an astronomical high. So of course, that's why we've been on such a big ripper. IAU gold, gold ETFs, fund flows are absolutely astronomical. Again, if we just kind of draw parallels with similar periods, we kind of get, often pretty rallying kind of periods and peaks. Here's the one from 2020. Here are some of them from back in 2011-12. And you can kind of see that often they are lining up with temporary highs, if not extreme peaks. So we love gold and we think that there's probably more in it, but at the same time, you generally need a breather after you hit it. And do remember, this hit the technical target, which we'll look at later. The length of the pennant has been achieved. And that is, so much faster than I thought. So much faster than most of you thought. When we have a look here at gold with the RSI also overbought, doesn't matter which one you're looking at, every indicator is going to show this. 1 month later, 10% of the time it's up. So I guess it's just a warning sign. Silver, oh my goodness, it's even worse when you look at those stats. And of course, everything else. Now, on the positive side, don't get me wrong. I like gold. You guys know I like gold. And central banks are, of course, purchasing it out of their minds. And everybody else is finally getting on the train after those years and years of us talking about this asset class. Silver's done astronomical numbers this year, and it's been pretty cool. But you've just got to realize when everyone's doing something, that's when I think I start to go, is that going to keep going? And even if we look at overlays of serious bull markets here for silver and gold, you'll notice that often this is where we get consolidation. So it's not necessarily a massive dump, although some of these did dump big time. But if it's on an epic one since 1972 kind of style, then it could just slow down for a bit, do a lot of burning of time, because this is a decent amount of time. This is months and months of sideways. And then it may go on one final run. This is, of course, where people are getting that $100. For me, I'm kind of getting the possibility of 80 could be there. And it's still a very exciting time in markets. But I wouldn't be buying when everyone else is floating around thinking about getting their candelabra from their great grandmother's kind of stash somewhere and then trying to smelt that thing down. That's when you don't want to be doing it. Let's have a look here at what is going on when it comes to US assets. Mike Zaccardi, courtesy of Goldman Sachs, I guess, in terms of the report here, shows that global equities make up 49% of portfolios. Global bonds are 37%. I just laugh at this comment over here. Data something on X says 37% of it is worthless. I'm only assuming they're going with global bonds. I have this feeling that everyone thinking that fiat's dead usually means it's probably not. But I think only a liquidity crisis can truly get people back on board the fiat train. So gold makes up 6, crypto is now 1%. And I don't believe this because they say real estate's 2. Yeah, no, that's not right. It's not really the stat. I understand why they're doing it this way, but let's be real estate is not 2% of the overall asset wealth. Let's have a look here at Bitcoin and its moving averages. You'll notice here from Blue Curtic some good stats there, even if it does keep dipping. We do believe we're in kind of that season of halving, which often is quite volatile between August and October. But the story of tokenization is likely not over. We're seeing more and more people jump on board. And I think it's going to be, a big thing, of course, into the future, especially into 2026. Let's now take a look at the earnings this week. We've got TSM coming on Thursday, and we've also got a little bit of other stuff happening. But really, it's going to be next week that's most important because that's going to be when we see that big tech load come through and we start to really focus in on some very exciting stuff as well around this earnings season. So make sure to subscribe, guys, because it's going to be a very interesting earnings season indeed. Let's now jump to the S&P. Now, what happened? Last 24 hours, we thought we'd get some clarity. Well, we got a long leg doji. That is a high, a low, an open and a close at the same level, and pretty much no real convincing here of either a strong uptrend or downtrend. This is about as neutral as you can get. And you might say, but Tom, look, it's above the daily 20. It is, but it's not really very convincing, isn't it, as being a neutral candle in itself. So that's a little bit of a problem coming off the back of that massive semiconductor trade. And it makes you start to wonder, well, what's in store? Because this is not normal. I mean, look at this statistical switch here. 1.7% in a day, up, down, all around, ends up pretty much the same session. What that's telling us is the market is getting a little jittery. And we're starting to see that in some of our lead indicators as well, which we'll go through in a moment. And it kind of shows that there's a possibility that we could actually enter down here into the weekly 20 moving average. Now, that's a 6,400. I'm not thinking it's the end of the world yet, but I can tell you one thing is that lever is going up and people are getting wild. And what this tends to do is it tends to bring extreme euphoria across so many asset classes. So they could also be driven by people chasing, especially small caps in the future. So something we'll be looking at because right now, small caps, of course, are beating the SPY, which we've suspected may be happening over the last couple of months, particularly since the Federal Reserve did their rate cut. And of course, that's more juice for this market should it occur. So what's happening right now? Well, we're stuck in a tight zone. We'll look at some other charts in a moment, and then we'll go through the options first to really find out what's more than likely going to happen. Let's check it out right now. All right, so when we're having a look at the S&P 500, you guys can see here, we've got the updated options levels. And what we're seeing again is this 6,600 seems to be, and 6,625 seems to be a very important point in this market. It's where we go from kind of being more a neutral gamma event to either a negative gamma through that or a positive gamma through around 6,700. So why is this important? Well, we are trapped between these two zones, kind of like the doji. We're just below the daily 20 moving average in terms of actual close highs, which we know is still technically a possibility of a bearish kind of sentiment. And there's clear neutrality here, which is the market starting to say we need to find out a catalyst to push either direction. If you're going to argue anything, of course, you always argue towards the upside. And the main reason is because, of course, the market has been in a very systemically good trend. And even with those analogs and those narratives, what you're seeing is that worst case scenarios of pullbacks are not that bad in comparison to where you're generally going to be leading into 2026 from. Now, 2026 could be a whole different storyline. That's where I expect extreme volatility, maybe multiple 10% sell-offs in the year with huge rallies in them. Not going to be like 25. It's going to be a very different style market. But let's have a look here at Tesla, 435, obviously sitting around 420, 430 puts, so around that support. And Nvidia getting down to the 180, which is now starting to become a pretty important put level as well. In terms of options, gold and Bitcoin, you can see here gold is still pushing high here. GLD just going ballistic. This thing's in massive positive gamma at the moment. Could it be reaching towards the stars of 400? I don't know. Anything's possible when markets go like this. But if you'd asked me 2-3 months ago, I had way higher targets than most people on gold. I thought that pennant would come in 4,000 to 4,200. The thing is beating my expectations. And whenever something beats even my lofty expectations, I start to say, well, it's cool, but at the same time, is it worrying? And we saw before, I wouldn't be entering new positions, at least in my opinion, right now. Now, some of you will disagree, but I think history shows us that there's usually some massive vol on the horizon. What's going on with IBIT? Again, 60, 62, 60. That's where we're seeing a lot of puts. So again, we're getting closer to that Bitcoin base before we go negative gamma. And a lot of these positions are actually sitting in what we call neutrality. So we're getting a lot of neutral markets with clearly a catalyst being needed to push us either way, whether that's a Trump tweet or truth, or whether that's going to be earnings season. We don't know yet. But what we do know is that the market is probably going to get more volatile leading into the end of the month. And the reason is because this is the most volatile month of the year. Speaking of volatility, clearly there's something going on in the bonds world. Bonds are not as happy as they were this entire post-Liberation Day kind of period. We broke up. We started to structure up higher. We have pulled back a bit, but still this is my often a little bit of a canary in the coal mine kind of position to say, well, maybe it's not as good as every other dip has been. Certainly, this is the worst dip we've had since Liberation Day in terms of it just looks the worst on statistics when you're looking at these charts. But that doesn't change the fact that in similar structures and similar positions, November has generally been positive. So you got to ask yourself, how worried do we need to be about like a 20% sell-off tomorrow? It's possible, of course. And with changing news, things could get much worse, but it doesn't look likely based on at least similar market scenarios. Let's have a look at the VIX. The VIX is 20, and of course, we've got here 25 as being a trigger. And small caps continue to do better than the large caps. You can actually see here we've got this downward trend line, and clearly there is some supply here. But if this starts to break out again, that's really showing us that the market is just greedily picking up anything that it can get its hands on. Dollar index is back around support, so this is going to be a very interesting level of the next couple of days of sessions. And gold is just absolutely just blitzing, like 42.34, guys. Like this is past my expectations. Like not that I don't think gold can get to $7,500 or something in the future, but you have a look here. Let's take the general distance that you're going to be looking for a pennant pattern, and it's overshooting it. And that's pretty cool, but it is almost right at that absolute best case scenario. So we are right there. 42.50 is kind of best case that I looked at, and that's an epic run. And that's coming off 2 as well, because it happened before. So that's 2 times we've seen big runs like this. And generally what happens is you go on these epic things that people can't believe it, yeah? And then you get this volatility, which often leads into sideways or giant vol sells. So if you have a look here, this top to bottom, let's take a quick look here. It's not that bad percentage-wise, but still it's about 10, 11%. That's just going to take us down now about to here. But what if it gets a bit bigger? This is a historic run that we've never seen before in a century on gold. Silver's doing something similar. It's hitting up at 53. We're starting to see volatility coming in. That tells me that we're getting near the pointy end. And again, I think silver can do better, but I think that it needs to take a breather before that, and timing will be everything. US oil, nothing to update there, guys, on oil at this stage. And Nvidia, of course, looks really horrible on a weekly chart, but I think the most interesting component is going to be semiconductors, which if we look at it, so it's like Nvidia looks bad, but then of course it could get much better on the lows. But if we have a look here at semiconductors and we go smaller time frames, it could be that actually a 330 plus break low, we'll do the options on this tomorrow, may actually tell us that this market is actually turning towards making a new lower low and going towards a weekly 20 moving average on the S&P. Because remember, we have number 10 trade here, number 7 trade here. If the market turns down, that's going to be negative. If the market blitzes a new high, 348, that's going to push that 200 plus Nvidia narrative. It's very neutral as we get up here into this top end area. And I know that people don't want to hear that, but you can kind of see why it's a bit more neutral. On China did drop quite a lot, hit a good level, so I can see why that's bought that zone. 25,000 is pretty solid for China. And NASDAQ is also showing that volatility, and you can clearly see there's something kind of holding it back. So on small time frames, you're going to be like saying, well, this is where the bears have to sit. So that's certainly where the bears sit. If the bulls are going to take control, you push a new high and you squeeze the rubbish out of it. And that's what happened last time and every other time before. So the new high is going to be the key for the bulls. And here it's very neutral, if not a little bit bearish on some of these markets. Bitcoin chilling around this low. Again, look at 116 as being kind of more bullish here for Bitcoin. And down here in these lows, you can obviously see there was this strong pickup through that area of structure. So again, I do expect that under 100, somebody's probably going to be trying to buy it up because tokenization is likely the story is not over. Ethereum, something similar, weakening here a little bit as people really consolidate after those massive losses and those massive liquidations. But something, of course, we will continue to track and be watching. Guys, if you're interested in following us over on X and LinkedIn, definitely do so. Posting there quite regularly. And obviously, if you want to find out more about replication, we do have courses, especially for day trading, which is more position basing, days into weeks even, and then advanced course. But maybe most importantly of all, if you're in the Brisbane or greater area, make sure to get over to our free trading event. Links in the description down below. Sign up, guys. It's awesome to meet you. See so many awesome people. This community, you guys are smart. There's people out there with big brains. I'm telling you what, it's like those memes with the giant brain exploding. You guys, some of you are like that. And yeah, it's awesome to meet you guys. So thank you so much for following. Thank you so much for subscribing. And as always, patience, react, don't predict. Don't be too worried about the mass media of, if it's in the press, it's in the price kind of problems. There's no doubt that everyone's super hyperbolic on gold and silver. We've been there for a long time. Remember, the lion's share of the profit is made before the general population finds it. The last third is kind of like the little crumbs that you leave to everybody else. So in this one, it's going to be, let's see how it plays. But at the same time, I expect volatility just around the corner. See you guys.